The Fed just did something to gold that it has never done in the entire modern history of the financial system. And almost nobody is talking about it clearly. Not CNBC, not Bloomberg, not the financial influencers on social media who are either screaming to the moon or screaming bubble without being able to tell you why either of those things is actually true. What I'm going to show you in the next 20 to 30 minutes is not an opinion. It is not a prediction based on hope or fear or a chart pattern someone drew on a whiteboard. It is a sequence of documented, verifiable events happening inside the Federal Reserve right now that every single person who owns gold, silver, stocks, bonds, a 401k, or a house priced in dollars needs to understand before this next phase plays out. If you have been confused about why gold keeps moving the way it does, despite everything the Fed has said publicly, this video is going to answer that question completely, and the answer is going to surprise you. Because here is what most investors do not realize. What the Fed just did does not simply affect the gold price, it affects the entire architecture of how money works in this country. And once you understand the mechanism, once you see the sequence clearly, you will never look at your portfolio the same way again. I am going to break this down into 3 parts. First, I am going to show you exactly what the Fed just did and why it is historically unprecedented. Second, I am going to explain the mechanism, the specific chain of cause and effect that makes this so significant for gold, silver, and every dollar-denominated asset you own. And third, I am going to show you where this leads, what the 3 phases of what is coming actually look like, and how to think about positioning yourself on the right side of it. Let us start with what just happened, what the Fed just did, and why it changes everything. In December of last year, the Federal Reserve quietly announced that it would begin purchasing $40 billion in Treasury bills every single month. They did not call it money printing. They called it reserve management purchases. And if you are thinking that sounds like a very careful choice of words to describe something that is functionally identical to money printing, you are right. Here is what reserve management purchases actually means in plain language. The Federal Reserve is creating new money out of thin air and using it to buy government debt. That is the definition of money printing. The word reserve management in front of it does not change what the mechanism does. It changes what it sounds like on a press release. Now, why does this matter so much? Because the Fed spent the better part of 3 years between 2022 and 2025 telling the American public, the bond markets, and the global financial system that it was doing the opposite. It was fighting inflation. It was tightening. It was reducing its balance sheet. It raised rates faster than at any point in 40 years, the most aggressive tightening cycle in modern history. And now quietly, without a major press conference, without the fanfare that accompanied the original quantitative easing programs, it has started going in the other direction again. Not because the inflation fight is won, not because the economy is in great shape, but because the math of the United States debt situation has left it with essentially no other option. Let me show you the math because this is where it gets important. And I want to be specific here because the numbers are the argument. This is not a vague warning about debt being bad. This is a concrete arithmetic problem that has a finite number of possible solutions. And gold investors need to understand which solution the Fed has already started choosing. The United States is currently rolling over approximately $9 to $12 trillion in federal debt this fiscal year at interest rates between 4 and 5%. The annual interest cost on the national debt has already crossed $1 trillion. That is more than the entire defense budget spent just paying interest on money that was borrowed in previous years. The total federal debt is now $36 trillion and climbing. The Federal Reserve has reported roughly $245 billion in cumulative losses since 2022. Now, you might be asking how a central bank that can literally create its own money loses money. The answer is that after 2008, the Fed started paying interest to commercial banks on the reserves they parked at the Fed, currently at rates above 4%. But the government bonds the Fed bought to bail out the system during the COVID crisis pay a much lower rate. So the Fed is paying banks 4% for money it has invested at 1 or 2%. It is running a negative carry trade on a scale that no private institution could survive. What did they call this loss? A deferred asset, which is a genuinely remarkable piece of accounting creativity that means we are technically insolvent, but we write the rules, so we are calling it fine. And then they started the reserve management purchases, $40 billion per month, creating money to buy debt to keep the system liquid. This is what the Fed just did to gold. Not in the sense of the gold price moving immediately, in the sense that the fundamental monetary architecture that gold is priced against has shifted. And when that shift becomes fully understood by the broader market, the gold price reflects it. The mechanism, why this is historically unprecedented. To understand why what the Fed just did is genuinely unprecedented, you need to understand a principle that my mentors, people who have been in institutional banking for decades, have always emphasized. Never trust the news to tell you where the money is going. The news tells you what happened yesterday. The data tells you what is happening right now with the real money. And here is what the data is telling us right now. Gold has been in one of the most aggressive uptrends in its modern history. Not a gentle rally, not a modest appreciation driven by retail buying or social media enthusiasm. A parabolic move driven by the largest and most institutionally sophisticated buyers in the global financial system. Central banks around the world bought over 1,000 tons of gold per year for 3 consecutive years. That is approximately double the historical average. Not retail investors, not momentum traders. Sovereign nations systematically replacing dollar-denominated assets with physical gold. Why did this start? It started in February 2022 when the United States made a decision that changed the calculus of every central bank and sovereign wealth fund on the planet. The U.S. froze Russia's foreign currency reserves, approximately $300 billion in assets that a sovereign nation had held in Western financial institutions were frozen overnight by a government decision. Nobody made a big public scene about it. But behind closed doors, in the Treasury departments and central banks of every country that is not a firm American ally, the same thought occurred simultaneously. If they can do it to Russia, they can do it to us. The dollar is not a neutral reserve asset. It is a geopolitical instrument. And the only reserve asset that exists outside that system entirely, the only thing that cannot be frozen by executive order or blocked by financial sanction, is physical gold. That is when phase 1 of the current gold bull market began, and we are still in it. But here is the critical thing that most people watching the gold price right now are missing. Phase 1 is the quiet, institutional, methodical repositioning phase. It is central banks walking very calmly toward the exit before the fire alarm goes off. It is sovereign wealth funds slowly, carefully reallocating without moving the price too aggressively, without drawing attention, without triggering the very panic that would make their own repositioning more expensive. There have been no major bank failures threatening the system yet. No mass corporate bankruptcies cascading through financial markets. No break in the Treasury market. The central bank is not yet being forced to buy government debt at emergency scale. Phase 1 is calm. Phase 1 is institutional. Phase 1 looks from the outside like gold just keeps going up for reasons that are hard to pin down. That is exactly what Phase 1 is supposed to look like. And that is precisely why most retail investors have dismissed or underestimated it. The absence of visible crisis is not evidence that the crisis is not forming. It is evidence that you are watching it in its earliest and most important stage, the stage where positioning still happens at reasonable prices. And the Fed's reserve management purchases are the first visible signal that Phase 2 is beginning to form. Phase 2, when the Fed becomes powerless. Phase 2 of what is coming is where things get genuinely significant. And I want to be precise about what drives it, because most of the commentary you will hear about this is either too vague or too sensationalized to be useful. Phase 2 begins when the market realizes that the Federal Reserve is not choosing to print money. It is being forced to. And that distinction between choosing and being forced to is everything, because a central bank that chooses to print money retains credibility. A central bank that is forced to print money because the alternative is a systemic collapse of the bond market has lost its most important asset, which is the belief that it is in control. Here is why the Fed is already moving toward being forced rather than choosing. Kevin Warsh, who has been nominated as the next Federal Reserve Chair, has stated publicly that he wants two things: lower interest rates and a smaller Fed balance sheet. And both of those goals sound responsible and sensible on the surface. Lower rates help borrowers. A smaller balance sheet means less market intervention, fiscal discipline, monetary credibility, all the right words. The problem is that these two goals are mathematically contradictory given the current debt situation. You cannot shrink the Fed's balance sheet while keeping rates low when you have $10 to $12 trillion in bonds maturing and needing to be refinanced over the next 12 months. If the Fed steps back from buying Treasury bonds as part of a balance sheet reduction, and if rates stay low, who buys all that new debt? The banking system is already under enough stress that the Fed is quietly doing reserve management purchases just to keep it liquid. Private investors and foreign central banks are already buying less U.S. government debt than they were 5 years ago. The bid for Treasury bonds is thinner than it has been in decades. So, the choice the new Fed chair will face, just like every Fed chair before him, is not actually the choice between